Hello everyone, welcome to Economy This Week series of Drishti IAS. My name is Disha Bhatt, and in this video we will be discussing about the economy related important current affairs which are important for your examination perspective. So today we have three topics of discussion. The first topic is related to RBI's advances deadline for FCNR deposits, and second news is related to the government launches fast DS for foreign assets disclosure, and third news is related to the MMDR amendment, the recent amendments which the government has taken with regard to MMDR Act. Okay, so let us start with the first news. So the first news is what? RBI has introduced a special facility to attract a fresh foreign currency deposits from NRIs through FCNRB accounts. Now, what is the full form of FCNRB accounts? It is foreign currency non-resident bank account. Okay, we will try to understand this news with the help of an example. Let's say that there is a person whose name is Rahul. Rahul is an NRI. NRI is who? See, Rahul is an NRI and he is earning money in US. He is working in US, so obviously he is earning money in this country. Okay, an NRI is a person who is an Indian citizen, but for some purpose, might be possible that for the educational purpose and for the work related purpose, they are living outside the India, right? So Rahul is an NRI. He is living in US and he is earning some money by working in a US company, right? So let's say he has 10,000 US dollar and Rahul wants to deposit these $10,000 in Indian banks. So he has two options. How he can do that is, see, the first option is either he will convert these $10,000 into rupee and then these rupee will be deposited in the Indian banks. The other option is he can open his FCNRB accounts. He can open his FCNR bank account. Here, what is the special benefit he is going to get is, here he do not need to convert these dollar into Indian rupee. Okay. Here, Rahul does not have to convert these $10,000 into Indian rupee. Ultimately, he can keep these dollars in an Indian bank account. So this is the facility which the FCNR bank account provides to the NRI. However, this facility is also available for the OCI, NRI and persons of Indian origin, right? Under this facility, banks can bring eligible foreign currency deposits and enter into dollar-rupee swap with RBI. Okay, we will come here again. Let us first of all try to understand the concept. Okay, so the foreign currency NRI deposit bank account is a term fixed deposit account maintained in a freely convertible foreign currency in India by non-resident Indian and persons of Indian origin in OCI. Okay, so here three things I want you to notice. The first thing is that it is a term and fixed deposit account. Only fixed deposits can be maintained here. Fixed deposits and time deposits I've already covered in a video. I made a video on money supply which is a part of our Economy Simplified series. You can watch that. But if in short I have to explain you, fixed deposits are those deposits which you cannot withdraw at any time. Okay, your money is logged with banks for certain duration. Okay, you cannot withdraw your money at any point of time as per your need. Okay, so if you want to deposit your money in FCNR account, so what kind of deposit will be made? It will be your fixed deposits. Your money will be logged with the bank account for certain duration. Either it could be for 1 year or 5 years. Okay. Now, in freely convertible foreign currency, again I have explained you previously as well. You do not need to convert your currency in Indian rupee. Okay. By NRIs, by PIOs and by the OCIs. Now, if we talk about the regulatory authority, see, this is an important part of this news. Okay. Now, these deposits are regulated by the Reserve Bank of India. That means if RBI wants to make any changes with regard to FCNR deposits, who can make these changes? The regulatory authority lies with the RBI. And it is covered under which act? It is covered under your FEMA Act 1999. Okay. Account type will be fixed and term deposits only. All right. Now let us talk about its key features. What benefit it is going to give to the NRIs and especially our Indian banks. Now the first key feature is no rupee exchange rate risk. The deposits is kept in foreign currency such as US dollars, European currency. It is not converted into Indian rupee. It will not be converted into Indian rupee. Therefore, changes in foreign currency exchange rate do not directly affect the deposits in its original currency. Let us try to understand this with the help of example. Again, let us take the example of Rahul. Rahul has $10,000. He has $10,000, and right now, what is the exchange rate? The exchange rate is $1 equals to 85 rupees. So, in the previous arrangement, if Rahul is not keeping his money in FCNR account, what Rahul has to do is he has to convert these dollars into rupee. In that case, he will get 8,50,000 rupees, right? Now he will keep these deposits in the bank account. But let's say after 2 years or probably after 5 years, the exchange rate has changed. Previously, the exchange rate was $1 equals to 85 rupee. Right now, the exchange rate is $1 equals to 95 rupees. Now see here, the exchange rate has changed. The value of rupees depreciated. Previously, you have to give 85 rupees to buy $1, but right now you have to give 95 rupees in order to buy $1. Now the value of rupee has depreciated. Let's say after 5 years, if the Rahul wants his principal amount back, he wants to withdraw his amount from the Indian bank. So obviously he will receive the less dollars. He has paid $10,000, but since the value of rupee is depreciated, he will receive less dollars. Okay, now you can calculate this. See, if you will divide 8,50,000 rupees by 95, obviously the value will be less than your $10,000. Probably he'll get around $8,000 back. So FCNRB deposits protects the NRI deposits from the exchange rate risk. Okay, so this is its first feature. Now, FCNRB deposits can be maintained in currency permitted by the RBI. You cannot keep your deposits in any currency. You can keep your deposits only in those currencies which have been permitted by RBI, such as US dollars and Japanese, Canadian dollars, Australian dollars, etc. If we talk about the tenure, FCNRB is a term deposits. Minimum tenure is 1 year and maximum tenure is 5 years. That means after 5 years, you can withdraw your money. Okay. Now, the next feature is repatriability. What does that mean? The NRI can generally take the money back abroad. Let's say that your deposit has been matured. So, after 5 years, you can take your principal amount as well as the interest you have earned. You can take all of that amount to your respective country. Okay. So, this is fully repatriable. The next feature is tax treatment. Now, the good part for the NRI or from the persons of Indian origin and OCIs are that interest earned on FCNRB deposits is generally exempted from Indian income tax. Whatever amount you will earn through those deposits, whatever interest you have earned through those deposits, it will not be taxed by the Indian government. Okay, but NRI may still have tax obligations in their country of residence. Let's say that you have kept some deposits in Indian bank and you are from US. So in India, you do not have to pay any tax, but if in the country of your residence, you are living in US, if there is any law, then there you have to give the tax. Okay. Now let us talk about what is the key difference between FCNR bank deposits and non-resident external deposits. So FCNRB deposits are maintained in the foreign currency itself. The good part is you do not have to convert your currency in Indian rupee. Okay. While non-resident external deposits are maintained in Indian rupee only. Does any kind of a currency risk is involved in FCNR? The answer is no. The risk is lower because deposits remain in foreign currency. Here the currency risk is involved. NRI bears the exchange rate risk. Okay. If we talk about the nature of FCNR, it is term deposit. If we talk about the nature of NRE, it is savings, current and term deposits. Okay. Now these are the examples. I've already explained you about the example thing. Now we have understood that FCNR is beneficial for the NRIs, right? But it is beneficial for our Indian banks as well. How they are beneficial? See, Indian banks are receiving a lot of foreign exchange through FCNR deposits. And you know how foreign exchange is important for our country. Okay. Also, RBI has also provided a swap agreement. Okay. RBI is also providing a swap agreement to the Indian banks. Under this, what will happen is, let's say that Indian banks has received dollars. I'm just giving you an example. Indian banks have received dollars, right? If Indian banks wants rupees, they can swap these dollars with RBI. In return, RBI will provide some rupees to the Indian banks. Now this will enhance the liquidity in Indian banks, right? So in a way, it is also beneficial for our Indian banks. Okay, now let us read the news. Under this facility, banks can bring eligible foreign currency deposits and enter into dollar rupee swaps with RBI. So it is a win-win situation for both. This gives bank rupee liquidity while RBI gains access to the foreign currency. Okay, our foreign exchange reserves will get increase. As a large amount of deposits already came in, RBI has advanced the deadline for fresh FCNR deposits. So RBI has reduced the deadline. Okay, because already we have received a lot of FCNR deposits. So RBI has reduced the deadline. The deadline has been shortened from September 30 to August 31st. Banks can execute the related dollar rupee swaps till September 11. So that's why this news is important for us. We have to discuss the core concept, that is FCNRB. Okay. Now, FCNRB deposits are counted as a debt creating capital inflow. Okay. Now, why I am saying that they are a debt creating capital inflow? Because somewhere the debt is being created, right? Indian banks are obligated to repay that principal amount to the NRIs. All right. So it is an inflow in India's balance of payment. Now I have a question from you guys. See, you have to tell me that FCNR deposits will be mentioned in which account of balance of payment. I have recently made a video on balance of payment. If you want a conceptual clarity on that, you can go and watch that video and then again come back to the video and in the comment section answer this question, that FCNR will be a part of which account? Will it be a part of current account or will it be a part of capital account? Do write your answers and also give me the reason that why it will be a part of current or capital account. Okay. All right. Now the next news is related to foreign assets of small taxpayer disclosure scheme. See, the income tax department has notified the foreign assets of small taxpayer disclosure scheme 2026. Okay. Now this scheme was already mentioned in this year's budget. Right now the government has done the implementation part. Now the scheme came into effect from 16th August 2026. It provides one-time opportunity for the eligible small taxpayers to voluntarily disclose certain and undisclosed foreign assets and foreign income. So it does not talks about the assets itself, it also talks about the income. Okay, again, let us understand this with the help of example. Let's say that Rahul went to Germany and he bought a lot of property and he earned certain income. He also invested in the shares of German company. Okay, and Rahul is an Indian citizen. He came back to India, but he has not reported all of those income and wealth which he has created in Germany to the Indian tax authorities. So here the government is giving them the one-time opportunity, the taxpayers or the citizens like Rahul who has earned certain income and who have created certain wealth in other countries. So one-time opportunities given to the eligible small taxpayers. They can voluntarily came up, they can disclose that how much wealth they have created outside. Okay, they can disclose their assets, any kind of a property they have invested in, or any income if they are making. Online declarations can be made up to 31st December 2026. The scheme was originally proposed in the Union Budget 2026-27. Okay, let us discuss that why foreign assets matter. See, a taxpayer may have assets and income outside India such as foreign bank account, foreign shares, foreign property. Let's say if a person has invested in shares of a US company, obviously he will receive a dividend in a fixed period of time. So that dividend is an income and it is important to for the Indian tax authorities to know about these income. Okay, for eligible taxpayers, foreign assets and income have to be appropriately reported in income tax return. The income tax department uses Schedule FA and Schedule FSI. Schedule FA is for the foreign assets and Schedule FSI is for the foreign source income for such reporting. Why the government has introduced this scheme? Because we want to collect more tax. The government wants to increase its revenue, right? We want transparency with regard to our financial inflows. Now let us discuss its features. See, this scheme is mainly meant for the small taxpayers such as students, young professionals, IT employees and NRIs who may have unintentionally missed reporting the foreign assets or income, right? Under this scheme, taxpayer have to pay 30% tax on the value of disclosed foreign asset or income. An additional amount equal to the tax of 30% will also be charged, making the total effective levy 60%. See, in total you have to pay 60% of tax. Let's say you have a property of worth 10 lakh rupees. So how much you have to pay to the government? You have to pay 6 lakhs as a tax to the government. Okay. Now the value of foreign asset will be calculated based in its fair market value as on 31st March 2026. Now see, this is a very interesting aspect. Again, we will understand this with the help of example. Again, let's take an example of Rahul. Let's say that Rahul has purchased a flat in Germany and the cost of that flat is 60 lakh rupees. Rahul purchased that flat in 2024. Currently, we are in 2026. Now, what is the fair market value of this flat? On which value the government will charge the tax? Will the government will charge tax on the 60 lakh? The answer is no. The government will charge the tax on the value which was around on 31st March 2026. Let's say in 2024, the value of that flat was 60 lakh. But in 2026, its value increased up to 1 crore. So the government will levy taxes on this 1 crore rupees. Okay. So this is the fair market value, which is as on 31st March 2026. Now this scheme has two categories of declaration. You can make declaration within these two categories. Category 1 is for the foreign assets or income that were not disclosed earlier. Okay. And that were also not taxed. Okay. Any asset or income which neither you have disclosed or neither you have paid your taxes. The total value should not exceed up to 1 crore. Category 2 is for those foreign assets that were already taxed and were acquired when the person was an NRI but were not properly reported. Okay, so again for the category 2, the limit has increased. The limit here is 5 crore rupees, while for the category 1, the limit is around up to 1 crore rupees. Now it is not that important for your examination, but still I have mentioned it. Now this scheme is a part of India's wider efforts to bring undisclosed foreign assets and income into the tax system. Okay. Do we have any law or bill with regard to the undisclosed foreign assets and income? Yes, we have Black Money Act 2015. Okay, let us also read about that. See, Black Money Act 2015 is a central law which was enacted by Parliament to deal specifically with undisclosed foreign income and assets. Now this act was enacted on 26 May 2015 and it came into effect from 1st April 2016. What was the main objective? Main objective was to tackle the black money and held outside India in the form of undisclosed foreign income and assets. It has provided a legal framework that how we can tax the undisclosed foreign income, in which manner the penalties can be applied, and offences and prosecution. Okay. Now all the tax compliance mechanism will be administered under the Ministry of Finance. This is important for you. This is important for your examination. Let us also talk about the black money because UPSC has asked a question on black money. Okay. See, black money means any income or wealth that is not properly disclosed to the government for tax purpose. Any money which is not disclosed to the tax authorities, that is called as your black money. And black money can even arise from the legal activities. Sometimes students confuse black money with the legal activities. That let's say if I have earned certain amount while performing illegal activity, let's say I've indulged in drugs and smuggling, and from that income will automatically become a black money. But this is not true. Black money can also be created from a legal activity. It might be possible that you are doing a very ethical work, but you are not reporting that income to the government. Let's say you are earning 10 lakh rupees, but you have reported that you are earning only 5 lakh rupees. So the rest 5 lakh rupees will automatically turn into black money. Doesn't matter if you are earning it through a good activity. Okay. So what is the main keyword? Main keyword is not properly disclosed. Now black money can be held within India or abroad. Okay. Now let us try to solve this question, this PYQ. Which of the following is considered as a major concern for the government of India regarding the creation of black money? Option A, diversion of resources toward real estate and luxury housing. Option B, investment in unproductive activities and purchase of gold, jewelry and precious stone. Option C, large donations to the political parties and the growth of regionalism. D, loss of government revenue due to tax evasion. Now see, here all the options looks very convincing. Okay, all of the reasons looks very promising. Students might get confused while looking into that option. But how you have to deal with such questions is, think from the government's perspective. Think what could be a major concern for you with regard to black money. What could be a major concern for you? Option D, loss of government revenue due to tax evasion. Okay, obviously you will miss certain revenue. There will be a loss of government revenue due to tax evasion. All of these options are written here to confuse you. Okay. All right. Now, the next news is related to MMDR Amendment Bill 2026. Okay. Parliament has passed a Mines and Minerals Development and Regulation Amendment Bill 2026. The bill aimed to create a uniform and predictable framework for taxation levies on minerals. Now, this topic is very important because UPSC has previously asked a question on District Mineral Foundation. Okay. This particular topic was asked, and DMF comes under the part of your MMDR Act only. This act is very old, MMDR Act 1957, but the government has made amendments from time to time. In last year, in 2025 also, the government made certain amendment. Okay, so we will discuss the recent amendment which has been made in 2026. Okay, if we talk about District Mineral Foundation, this foundation was made under this act. It is for those people who lives in nearby the mining areas, because mining has certain environmental consequences as well. So to protect those people and to take care of those people, DMF was created, where certain amount will be added in that particular organization, in that foundation, in order to help the people who are living in mining related areas. Okay. All right. Now, the main objective of this amendment is because it seeks to reduce uncertainty caused by the multiple state level levies and encourage investment in domestic mineral production. Okay, what we are trying to do here is we are encouraging companies to acquire mines, to mine the minerals, so that we can reduce our import dependence. And how we will encourage the companies? By simplifying the multiple state levies. Okay, we will try to build a uniform structure. Okay, and that's how we will increase our domestic mineral production, so that we do not have to remain dependent on the imports. However, it has raised concern over the fiscal federalism, state taxation powers, and central state relations. The critics have argued that this particular amendment has reduced the state's fiscal autonomy. Okay, and it has given center the more power. Now, let us talk about the key features of this bill. The first is union control over the mineral bearing lands. Okay, the bill has amended the section 2 of MMDR Act 1957. It explicitly brings mineral bearing lands under the regulatory control of the union government. Now, the mineral bearing land will be all the rules and regulations with regard to the mineral bearing land will be made by the central government. Okay, now there is a restriction on the state levies. A new section 9D has been created, which restricts state from imposing tax, cess, and other levies. These restrictions apply to the mineral rights and mineral bearing lands. States may impose such levies only if they fulfill the government conditions. The government will provide certain conditions, and if states are able to fulfill them, then only the state can levise taxes and other any other as such fees. Okay. The third feature is retrospective relief. Certain unpaid or unrecovered past levies will become invalid. If the state has levied any form of a fee or tax, that will become invalid. However, amount already paid will not be refunded. If any company has already paid that amount, it will not be refunded again. Okay. Now, central rule making power. The bill has amended section 13. Now, the central government will prescribe the conditions under which the states can impose future levies. Okay, state can impose taxes, but only if they fulfill the government conditions. Okay, now let us talk about the entry 54, entry 23 and entry 50 of the union list and state list. If we talk about the entry 54 of union list, we get to know that Parliament can regulate mines and minerals. Very important. Okay, when it declares such regulations expedient in the public interest. So again, Parliament can make regulations with regard to the mines and minerals. If we see the entry 23 of the state list, right, it gives states power over the mines and minerals subject to the union legislation. So again, we can clearly see that Parliament has the more power, union has the more power. States can also make the laws, but again, union has the more power. Okay. Now, why this bill is important? Because there is a tax certainty. Since the central government has acquired a more control and central government has the more power, it will try to bring the tax system more uniform. Okay, so it will reduce the uncertainty arising from the multiple and unpredictable state levies. Now it will create the more stable environment, more stable fiscal environment for mining companies. Now the mining companies will be provided a more stable environment. It will provide the uniformity as well. It will promote a more universal taxation framework across state, and it will reduce the compliance cost for the companies, for the mining companies. Okay. Third is investment and mineral production. Lower regulatory uncertainty may encourage private investment since the regulatory uncertainty has been reduced. So mining companies will be encouraged to do more production. The investment will be on a higher side. Mineral exploration will be increased, and domestic mineral production as well as the development of critical mineral, everything will be increased. Okay. A stronger domestic mineral sector will reduce India's dependence on imports of strategically important minerals. That I have mentioned in the first slide itself. Okay. Now, let us talk about the original act, that is Mines and Minerals Development and Regulation Act 1957. The MMDR Act 1957 is the main governing law of mine and mineral development in India. It was passed in Parliament. It was based on the entry 54 of the Union List. We have already discussed entry 54 under the 7th schedule. Okay, this is important for you. The 7th schedule has mentioned the three lists. There is Union List, there is State List, and there is concurrent list on which both center and state can make the laws. Okay, the act gives central government an important role in regulating the mines and minerals development. Okay. Now, the last amendment in 2025, for this amendment we have already discussed, but previously in 2025 also, there was this new amendment which government introduced. So, it introduced the concept of mineral exchange to establish the registered electronic marketplaces for transparent trading of mineral. Okay. So, the mineral exchange was announced in 2025 amendment, where you can do the electronic trading of mines or ores. Okay, let's say that there are two companies, company A and company B. Company A has a iron mine and company B manufacture steel. Company B wants some iron from company A, so they can do it from the electronic marketplace. So that was introduced in 2025. Okay, it also removed the 50% sale cap on the captive mines, allowing them to sell mineral production in the open market after meeting their end use requirement. So the 50% cap is also removed from the captive mines. What is captive mine? See, let's say that there is a steel company and steel company has acquired an iron ore. Okay, and let's say that they have explored 100 tons of iron. So earlier there was a 50% cap that out of these 100 tons, once that steel company will use that iron to fulfill its domestic requirement, it will use that iron to manufacture steel. The rest of the iron, it can, sell it in the market. But there is a sale cap. There is a 50% sale cap. Only 50 tons of iron it can sell in the market. Right now, this 50% cap is also removed. Okay. So this was about 2025 amendment. Now, this is a previous year question which has been asked by UPSC. You can try to solve this question. See, with reference to the management of minor minerals in India, consider the following statement. First, sand is a minor mineral according to the prevailing law of the country. Second statement, state government have the power to grant mining leases of the minor minerals, but the powers regarding the formation of rules related to the grant of minor minerals lie with the central government. Third, state government has a power to frame rules to prevent illegal mining of minor minerals. Choose the correct option and write down in the comment section. Now, this is a last practice question. Let us try to solve this as well. With reference to the foreign currency non-resident, that is FCNR bank deposits, consider the following statement. Statement first says, FCNRB deposits can be maintained in the form of savings, current and term deposit account. Is this statement true? Second, the depositors do not need to bear any currency exchange rate risk during the tenure of the deposit. Third, interest earned on FCNRB deposits is fully exempted from the income tax in India. Fourth, FCNRB inflows are categorized under the current account of the India's balance of payment. Again, try to solve this question. Write down your answers in the comment section. I hope you liked today's lecture. Thank you so much for watching. Have a good day.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.